Welcome to the Lend Academy podcast, episode number 138. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It. Support for the Lend Academy podcast and the following message comes from Wonder Capital, the easiest way to invest in large-scale solar energy projects across the US. With Wonder, you can help finance renewable energy projects while earning up to 7.5% annually. To get started, visit wondercapital.com/lendacademy. Wonder Capital, where impact investing meets capitalism. Today on the show, we are talking mortgages, and in particular, talking about revolutionizing the mortgage application process. So I'm delighted to welcome Vishal Garg. He is the founder and CEO of Better Mortgage. Now, as I just previewed, Better is really doing something that many would have considered impossible just a few short years ago. They're basically taking the mortgage application process, which has been a painful and arduous experience. I've been through it several times, and every time it has been painful and arduous. And they're making it into a quick and simple and even somewhat enjoyable process. And how they're able to do that is really the subject of this podcast. It's a fascinating story. We talk about technology, we talk about data, we talk about underwriting, and we talk about the consumer, what they want, and how Better is able to deliver what they want. It really was a fascinating episode. I hope you enjoy the show. Welcome to the podcast, Vishal.
Thank you so much, Peter, for having me. Really excited to be here.
Okay, so let's get started by giving the listeners a little bit of background about yourself and what you've done in your career to this point.
Thanks. Just a little bit of background. I started my career in Fintech almost 20 years ago. I think before sort of even Fintech was a word. I was an analyst in the Mergers and Acquisitions department at Morgan Stanley. I dropped out of the analyst program after a year to start a company called myrichuncle.com, which was the first online student lender. The original product was we would give kids money for college in exchange for a percentage of their income. And then over time, we built a data set of outcomes post-graduation, which we helped basically create the first direct-to-consumer online student loan company. Eventually took that public in the mid-2000s, sold a chunk of it to Merrill Lynch in 2007, and they became the majority investor in the company. And then in 2009, they shut the company down. I spent 2009 to 2013 building up an asset management business, got to about $6.5 billion in asset management, mostly taking social media data and applying it to mortgage-backed securities and student loan securities, asset-backed securities, and effectively using that to better underwrite and trade the securities. And then I went to go get a mortgage when my wife and I were pregnant. My wife was pregnant with our second child, and we were looking to buy a home. And I found that process so frustrating and basically used the experience I had in both the finance side as well as creating consumer internet companies and financial services to launch Better.com.
Okay, you launched Better, or you get the idea for your company, and then, from what I understand, is you go ahead and buy a bank in 2015, which I thought was a curious move. Can you tell us a little bit about that time period and why you decided to go buy a bank?
Well, what ended up happening was I started researching the mortgage business. I got curious when basically we lost our house that we were going to buy to basically a broken mortgage process to an all-cash buyer. And I was both frustrated, but I was also intrigued. I was like, how is it that mortgages are so bad? Why are they not better? There are all these companies revolutionizing, the delivery to consumers of credit across a variety of asset classes, but seemed like mortgage was totally untouched. And so I researched about 20 different mortgage banks and started diving in a little bit and realized that fundamentally creating something from scratch was going to be a really, really tall order because of the regulatory requirements, which are on a state-by-state basis. There's effectively no federal preemption. And then on top of that, the localized nature of the market. So thought what would be actually best is to take over an existing mortgage company, one where all of the pieces were connected from, consumer to end liquidity provider, and then take that and effectively fully digitize it, and then over a period of time, automate it. And so that's what we decided to do, is actually take over an existing mortgage bank that had been in operation for about 10 years, where the principals knew that the world was about to change, but weren't able to really build the next version of it. And that gave us a real head start in getting going.
Right. Yeah, that makes sense. So then, why don't we? I just want to step back a little bit, and I went through the mortgage process a while ago. It's been a little while, but I'm curious, from your perspective, what are the major problems in the mortgage application process today?
Yeah. So I would say that there's two major problems, right? One is speed and certainty, and the second is cost. So the first problem, speed and certainty, a mortgage company on average can't tell you whether you're going to get the mortgage or not for anywhere between 30 to 60 days. Mm-hmm. So you're shopping for a house and you don't actually know whether you can actually buy the house. And that's because at most banks, the process is totally disconnected. So you have a loan officer who's usually a commission counterpart, and they're really like a salesman. They're out there, quote unquote, hunting, either by talking to realtors and trying to meet customers as they're shopping, or by, sitting in a call center and buying leads from companies like LendingTree and calling customers all the time. And that person is good at selling. They're not really good at advising, and they're not really good at processing and underwriting. So what happens is they collect a few pieces of customer data and then hand it over to a processor. And then the processor compiles a bunch of documents and then hands it over to an underwriter. And then the underwriter hands it over to a funder, who then hands it over to a closer. And these groups at banks number in the thousands. And it's basically mostly people taking a PDF from somebody else, adding a few pieces of data to it, and then verifying it with a third-party source, and then moving it down an assembly line. So they're really sort of assembly. But no one of them is talking to each other, and none of them actually has the ability to do anything or change anything with the process. So if there's anything that goes wrong, you basically start from scratch all over again. Mm-hmm. And that means you don't know where you're at in the process, and you don't actually have any certainty that it's going to close or close on time. So it creates this huge, stressful process that then gets to the second point of cost. So the average mortgage bank, it costs $8,200 to make a mortgage.
That's crazy.
That's crazy, right? So like in what it costs like Hyundai to make a car and ship it across the ocean, a typical mortgage bank generates a PDF that you sign at closing.
Right.
And that's mind-boggling. And it's even worse. At a big bank, that number might be $15,000. Wow. So if you think about that, that's the average mortgage in America is $250,000. So $8,000 of manufacturing cost is literally 3 points.
Right.
That means, and that translates into Americans basically paying 1% more per year simply because of the commissions and the cost than they should be. Can you imagine that? $15 trillion, the largest financial asset class in the world, right? The 85% of consumer finance literally is 1% or $150 billion a year more expensive for consumers than it should be because of the commissioned loan officer and the broken process.
Right.
And so we thought that there's this real capability to change all of that and give that saving back to that consumer and actually let people buy a better house.
Mm-hmm. Mm-hmm. Sure. So let's just talk us through then how you are actually making the process better.
Sure. So what we've done is effectively built a rules engine. So what we observed is in mortgage, unlike many of the other asset classes, most of the credit risk is absorbed by the GSEs, Fannie and Freddie, or the FHA, or the VA, or any of the other like mortgage insurance companies. Mm-hmm. And so fundamentally, it's about surfacing consumer attributes, surfacing property attributes, verifying those, and then matching them to the best end investors' preferences. And those preferences take place at an attribute level and at a price level, and then building this three-way matching engine. And in fintech, others have built sort of originally in their original incarnations, like Prosper, Lending Club, Zopa, built, what P2P basically was like a one-way, a single, person to investor matching engine. And, a three-way matching engine, because of the recursive nature of a three-way matching engine, is a little more complicated, but that is effectively what we built. And what that allows us to do is take the bulk of that cost out of the transaction, save the consumer time, and actually provide certainty, because we know that the match is perfect, whereas your typical mortgage broker is sort of just throwing spaghetti against the wall into the process and hoping that, it sticks all the way through from, loan start to loan closing.
So how do you know that the match is going to be perfect?
We know that the match is perfect because the engine that we built on a rules basis is effectively taking the data from the consumer or getting the data direct from the source. And so we built APIs into all the different places where you're going to need source data, whether it's property data, title data, appraiser, valuations, pay stubs, tax returns, all that. And so we know that we're getting the data from the end source rather than from the consumer or having to ask the consumer for it.
Right.
And then what we built on the back end is actually an investor rules engine. So we built our own interest rate, engine, pricing engine, as they call it in mortgage technology, and we built our own underwriting engine. And so effectively what we do is we're not like many fintechs at the back end typically create clusters. So let's say a lending club or others might create a cluster and say, this is grade A, this is grade B, grade C. But you might remember, and you've been doing this for a really long time as well, and been there right at the beginning, originally at Prosper, you could actually just say, hey, I only want to lend money to people whose last name starts with R, and then have this attribute and this attribute and that attribute.
Right.
And that's what we did. We built that matching engine at the back end. So an investor, we basically take the investors, and we have 21 major financial investors. We're the only fintech that's direct Fannie seller servicer, so included effectively the biggest, GSEs. And so 70% of the mortgage market is on our platform. So we have now $700 billion of capacity on our platform from the investor side. And each of those investors, we take their 200-page PDF underwriting rules and we manifest them in our platform. And because the match is totally digital, it's perfect all the time.
Okay, so when, and I don't know what, I presume you've got some of the bigger, the cities and Chases of the world, but you obviously you can tell us, but so you obtain the information from the mortgage applicant, and you've got all the data that you need to pass to a city or Chase or whoever, and they can make an instant decision. Is that what you're saying?
No, it's actually better than that.
Okay.
I don't pass any of your data to Chase or Citi or Wells. I know they'll finance us to make the mortgage to you, and I can make that decision instantly. And I know not only will Chase, Citi, or Wells finance you, but also Penny Mac and Fannie Mae and a whole bunch of other people. And by the way, so we can then say that actually Penny Mac really wants to find loans for consumers with these attributes who are buying townhouses in this particular area. And so we can pass on that savings directly to you.
Okay. So you've basically got agreements with all these organizations, and they've basically given you the authorization to make these loans. Is that how it works?
That's correct.
Wow.
That's correct. They've given us 100% certainty that they will finance us making these loans.
Right. Okay.
And then fundamentally, the best thing is we are a direct Fannie seller servicer, so we have a direct, one of the counterparts effectively providing us a guarantee of financing is Fannie Mae, which is a government-sponsored enterprise. Right.
So you said you've got, you say you're $700 billion of capacity. Now I imagine you're far less than that. So you've got all these companies lined up. I mean, can you give us a sense of the scale that you're at today?
We're on track to do $1 billion of loans this year.
Okay. So you still got some runway to go, but you're certainly getting into some serious numbers there. Okay. So then, who is the typical customer for you guys? I mean, who comes and applies for loans?
Yeah. So we have the customer that's discovered us and really whom we are amazing for is a first-time home buyer or someone refinancing for the first time. Because when they're going through the process, they have such little knowledge about how bad mortgages
right.
are and how bad the process is about to be. And fundamentally, a lot of them think, or they talk to their, parents or others, and they just hear bad stories or horror stories. And our engine is very powerful for them because most of these people have attributes and characteristics that are very different than the attributes and characteristics that their parents had. And your traditional bank or mortgage company can't even fund that. Or more importantly, your traditional mortgage banker or mortgage broker, the guy sitting in the branch at Citibank or Wells Fargo, cannot even surface all the permutations and combinations that are of product type that are actually available. So so they have a different expectation. The consumer is not, while they want support and they want help, the banking system is basically unable to kind of service them. So we are really great for people, whose balance sheets look very different, right? Like the traditional mortgage process is built for a 20% down payment or more buyer. Most of these consumers, they're coming in, and your average 38-year-old consumer today has been spending their savings over the past 10 or 15 years paying down their student loans.
Right.
They still have some outstanding. They've saved up a little bit of money to buy a place, but literally they've probably been renting for 15 years and have been paying their rent on time, and they're wondering why they're paying their landlord's mortgage payment. And so we're helping them surface these first-time homebuyer programs where with as little as 3 or 5 or 7% down, you can buy a house and use that as a vessel for savings and socioeconomic mobility. So we're able to find them and help them do that. The other thing that we see, which is interesting, is your traditional mortgage process is built for someone who's a vice president at IBM and
right.
Has W-2 income and a salary job. And we see consumers who are being paid, if they're working at a major tech company, or they're being paid in restricted stock units, and that's something that other banks or mortgage companies, allocate zero value to, and we are able to actually, by being able to digitally verify that, show that it's consistent, directly interface with Fannie Mae and the like to provide you credit for that type of income, for the 1099 income, their RSU income, for other types of income, small business income. Our machine is able to help ingest that data, verify that data, whereas every other mortgage player is saying, oh, this is complicated, I don't want to deal with this, right? Because when you're dealing with somebody like who's commissioned, they just want the easy loans, right? They want the loans to somebody buying a $2 million place,
right?
And the person who's buying a $300,000 place. That's not what our engine does. Our engine treats everybody really well, and our team of non-commissioned loan consultants, they're there to help and empower the consumer to get the best outcome and the best house that they possibly can. So we're seeing a lot of that, which that gets down to the last thing, is that because we've taken all the stress and the brain damage out of the process, we can spend time educating these consumers. Because the myth, the sort of the home ownership myth in America used to be, well, everyone should buy a house. And, the credit crisis, post the credit crisis, people are worried that, based on what happened with their parents or with their parents' friends or others, they have so many horror stories of someone who just bought a house they couldn't afford. People want to buy a house. They really do. But they want to buy a house they can afford.
Right.
And so we can surface that and then actually carry through with that all the way through the process.
Right. Okay. So on your website, it says, we won't rest until you can get a mortgage in 1 day at no cost. So I guess it brings up several questions. Obviously, the 1 day piece is fascinating. Like the last time I got a mortgage, I think it was about a 60-day process for me, and it was highly frustrating. I wish you guys were around back then. But anyway, I want to ask, how long does it take today, and how close are you to, and what needs to change to get to this 24-hour turnaround you talk about?
Yeah, so actually, we're really proud to say that today, in certain markets, I think 6 markets, in Seattle, in San Francisco, in Atlanta, in San Diego, LA, and Denver, we can do a mortgage in one day. We can take you from going online on your mobile, getting pre-approved in 3 minutes, allowing us to pull some data from your employer and, your taxes, locking a rate in 15 minutes, getting fully verified, underwritten, and being eligible for our better offer process, which basically gets you a commitment letter, turns you from a mortgage buyer into one that can waive their financing and appraisal contingency in one day.
Wow.
So that is live. Now, regulatorily, we still need 10 days to close because we have to issue some disclosures, and those disclosures have a cooling off period.
Right.
But that's just sort of a closing process. But we can give you total certainty and back it up with a guarantee that if you were to waive your financing contingency and for whatever reason something falls through, we'll back up your earnest money deposit with up to $50,000. We'll reimburse you for that. So we're doing that in 6 markets. Those 6 markets are probably like 15% of American houses, right? We're going to take that national, but we're there. We're at the beachhead. We got to push through. So we're super proud that we've been able to make that happen. And yes, that mortgage today is with 0 fees and our best price guarantee, where we guarantee we have the lowest price by at least $1,000, or we'll pay you $1,000. So it comes with our better price guarantee. So no fees, better price guarantee, 1-day mortgage, live today in 6 markets, national by end of 2018.
Okay. Wow. So I take it then, if you're doing 1 day, you're not actually physically speaking or interacting in any way with the buyer. Is this all automated, or is there? I mean, obviously, if they've got to enter their data, they've got to give you some data. But how automated is the process?
It's as automated as you like it to be. So you can do this without ever speaking to us. You can do this while speaking to us the whole time through. So if you want to be on the phone the entire time this is all happening, that's cool with us too. So we generally like to talk to the consumers that we're empowering with this tool. But yeah, it can, effectively it can be done entirely automatically.
Right.
There are some property types where, the data may not be as clean, or, new developments, things like that, which might require an on-site visit, but that happens all in 1 day.
Right.
Each of these markets, we have local appraisal panels and local property inspectors that can do, all of the things that need to be done within a 24-hour period.
Wow, that's impressive. That's impressive. So, and you said on a panel one time, I remember that your rates can be, or I don't know if they are all the time, they can be better than if you go to Chase or Citi directly. The rates that you offer can often be better. I mean, is that true, and how is that possible?
That's correct. That is correct. So we can give you a loan cheaper than Citibank can give you a loan using Citibank's financing.
Right. Okay. And so,
which is crazy, yeah. Right? That's been the traditional challenge of fintech, is that fintech companies are able to create a better customer experience, squeeze operational costs, and make things cheaper. But fundamentally, they've had a cost of capital disadvantage. By aggregating the demand for financing for all these investors, including 6 of the 7 largest banks, and by our, one of the benefits of us taking over an existing mortgage bank, and by having the direct interface with Fannie Mae, where we're a direct Fannie seller servicer, which is better than most of the banks in the country, we actually do not have a cost of capital disadvantage. We actually have a cost of capital advantage with respect to us versus 99% of the banks in this country.
That's amazing. So then, how are you making money? What's your business model?
What we've been doing is, the way we make money is the investors compensate us for manufacturing a better mortgage at a cheaper rate, so it's great, right? So we are giving a cheaper rate to the consumer. Mm-hmm. And so now that loan, by the fact that the rate itself is cheaper, has a lower default risk profile.
Right. Yep.
And so we're able to take a loan and actually get a premium for it by enabling a lower chance of default and by manufacturing it at a lower cost. And so we're able to, and we make that premium, and that's how we make money.
Right. Okay. Interesting. So then we chatted a few months ago, and I remember went back and looked at my notes from that call, and you said at the time, you said, we are building the Amazon of credit. So what do you mean by, does this mean you're going beyond the home mortgage? I mean, what do you mean by that?
We believe the home process, the home ownership process, I mean, that's a $30 trillion asset class where, somewhere like 10 million consumers are either buying or refinancing a mortgage, where the size of that is $2.5 trillion. So, and what we've done is we've done the hardest financial asset class first, and we've made the process of getting approved for a mortgage like today's process of getting a retail installment loan similar. And where we believe is that obviously if we can give you a mortgage, which is the largest financial transaction that most people will ever undertake, and we have your income statement, your balance sheet, your cash flow statement, we have all your preferences, all your spending data, we are able to easily decision you for any other asset relatively quickly. So whether it's, insurance, we do title and homeowners and others as part of our process today. One click, if we can get you a house, we can certainly, the next time, you see a car, take a picture of the VIN number, and we can decision you for that and do that in one click. You want to, build a new deck, take a picture of the deck at Home Depot, and we'll be able to get you that and add that to your mortgage rather than a 12% retail installment loan in one click, and have that payment be tax deductible and increase the value of your home and lower your existing mortgage payment, in which case it might cost you less than what you were, thinking about. So all of this becomes possible once the mortgage becomes digitized.
Right. Yeah, that makes sense. That makes sense. So we're almost out of time, but I want to get, there's another one, something I'm very curious about, and you touched on it a little bit earlier, but I want to talk about data and sort of the data sources that you're using and how you're like, is your secret sauce and able to sort of get all this done so that you can verify this person, in an automated fashion? Is like, tell us about, like, obviously you're pulling in the traditional data sources, but which most lenders do. But I'm curious if there's anything else that you're doing that on the data side to help kind of measure the risk or underwrite these customers.
I mean, what we are creating, and when we again talk about the Amazon credit, we're creating an ecosystem where people are going through their largest financial transaction. So we're surfacing areas they need further education on. We're surfacing things that they can do to improve their financial life. So we do, one of the use cases of refinancing a mortgage is for debt consolidation or to buy something new. So by surfacing to the consumer effectively if they plan to pay all their bills on time, right? Hey, not only can you do this refinance and lower your rate, but actually we can, refinance your student loans, we can refinance your auto loan, we can refinance all of these things. And it's just like one click, and we can just show you if you do that and you take this 5-year asset and you turn it into a 30-year obligation, this is what your monthly payment will be and how much money you'll save. This is how much money you'll save in interest by taking this 12% loan and turning it into a 4% cash out refi. All of that we're able to do, so we're able to capture this data, but more importantly, we're capturing the data and what others are taking and effectively sending only the sliver that an investor or a securitization trust or a rating agency needs. We're actually taking all that data to add super rich context around the consumer's personalization, like personalized optimization, and using that to optimize fundamentally the one thing that matters to the consumer, which is the monthly payment.
Mm-hmm. Right.
And the cost of that.
Got it.
And so we're building a super rich data ecosystem that then we can utilize for all of these other things.
Mm-hmm. That makes sense. So last question, I can hear in your voice how passionate you are about this process. And it is quite impressive what you've been able to get done today. But I'm curious about what you are working on personally today that most excites you.
Yeah, so the thing that excites me the most is to be able to turn any consumer into a cash buyer. Like, for me, that's like 3 years ago, I lost the place we wanted to live in and raise our children in to an all-cash buyer. I want to be able to take any American consumer who can qualify and be able to turn them into a cash buyer in one day. Mm-hmm. So they can get, and buy the house of their dreams and raise their family, improve their socioeconomic status, be able to use that mortgage, and be able to use that house to send their kids to college and pay for their retirement. And I think that's super, super empowering.
Right.
Super empowering. And it's like, basically it would be the most amazing thing that, that I could end like my fintech career with.
Right. Well, it is a noble endeavor, that's for sure. Much more to talk about, but we're going to have to leave it there, Vishal. I really appreciate you coming on the show today.
Thank you so much, Peter. Really appreciate you having me.
My pleasure. See ya.
Cheers.
Wow. I don't know about you, but I thought that was quite something. Pretty amazing they've been able to take a 60-day process down to 1 day. And I think the reality is banks offering mortgages in the way that was done in the 1990s and 1980s, those days are numbered. I actually think it will be literally impossible to obtain a mortgage in, I don't know whether it's 5 or 10 years' time. So definitely 10 years. It will be impossible to obtain a mortgage that takes 60 days. Every mortgage will take less than 7 days, I think. And you're going to see companies like Better, they're changing the expectations. People go into buying a house expecting it to be painful. As companies like Better get bigger and more well-known and others enter the space and do things in a similar way, it's going to become a totally different market. And I think it'll encourage actually more people to buy homes. And as Vishal said, they're able to buy homes, better homes that they can afford because they're getting a more efficient process that clearly is it's not going to cost $8,200 or whatever he said. It's going to cost probably in the low 3 digits, maybe even less when it all comes down to it. So it's going to become a much more efficient process. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. This episode of the Lend Academy podcast was supported by Wonder Capital, the easiest way to invest in large-scale solar energy projects across the US. Experts at Bloomberg estimate that $2.8 trillion will be invested in solar energy by 2040. With Wonder Capital's solar investment platform, individuals can now take advantage of this economic opportunity. Visit wondercapital.com/lendacademy to find out how you can begin investing in solar energy projects while earning up to 7.5% annually and also helping in the fight against climate change.